Welcome to Japan Market Brief, the daily English audio update on what moved Japan's markets and what matters next. April 10th was another positive day for Tokyo, but the character of the rally changed a little. Japan's Nikkei 225 rose 1.9% to 56,957.3. At one point, the index was up more than 1,000 points. The clearest support came from fast retailing, where strong buying followed upbeat guidance and management comments that the immediate impact from the Iran situation remained limited. That matters because the market was no longer rising, only because fear had faded. It was also rising because investors were identifying specific companies they still trusted in a difficult macro backdrop. The external setup remained supportive. The S&P 500 gained 0.62% and the US 10-year yield stayed broadly steady. That combination gave Tokyo enough breathing room to continue the rebound. But the local picture still looked mixed. Dollar yen moved back to around 159.2, so the weaker yen story did not go away. And oil briefly returned above $102 a barrel, which reminded investors that the energy shock has cooled from the worst levels, but has not disappeared. That is why today's gain should be read carefully. It was a strong market day, but not a full all-clear signal for Japan's economy. There was no single fresh Bank of Japan event driving the session. Instead, the main point was that the yen stayed weak without becoming disorderly. That helped equities stay focused on earnings and stock selection. Still, the currency remains important. A weak yen can help large global companies with foreign earnings, but it also raises import costs for households and domestically focused businesses. So the same currency backdrop that helps some winners can still hurt the broader economy. That tension showed up in the domestic data. Japan's March Producer Price Index rose 0.8% from the previous month, with fuel and energy-related items playing a large role. NHK also reported that the Consumer Confidence Index fell for the first time in 3 months. So even as the market climbed, households still looked cautious. That suggests equities are moving ahead of the consumer mood rather than being fully confirmed by it. This is important because the current rally is starting to look more selective. Investors are not simply buying everything in Japan. They are favoring companies that can keep earnings strong even when oil, freight, and currency risks remain in the background. Today's stock to watch is fast retailing. NHK reported that the Uniqlo operator said the current effect of the Iran situation on earnings was limited because it had already reviewed shipping routes. Separate coverage also said the company raised its profit outlook on robust global demand and stronger sales in Japan. That gives the stock a double roll today. It was one of the clearest reasons the Nikkei moved higher, and it also shows what kind of corporate profile the market is rewarding. Fast retailing combines global demand, brand power, and enough operational flexibility to absorb near-term logistics stress better than many peers. That makes it more than a retail name for today's discussion. It becomes a signal about leadership. If Japan's macro environment stays noisy, the market is likely to keep favoring large, high-confidence companies that can protect margins and keep delivering growth. In that sense, fast retailing helps explain why the index can rise even while the broader domestic story still looks uneven. For the next session, 3 things matter most. First, whether oil stays contained after that move back above $102. Second, whether dollar yen remains stable rather than pushing into a more stressed zone. Third, whether more domestic indicators continue to show cautious households and cost pressure. If those warning signs remain while equities keep rising, the market will look less like a broad-based recovery and more like an increasingly selective earnings rally. That is all for today's Japan Market Brief. Thanks for listening.